Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app. Well, it's 1 o'clock on the East Coast. It was 11 o'clock a.m. on the East Coast. But as we have said a number of times, we're going to do today at 1, 2, because we need Elizabeth Young Thomas with us, and 11 didn't work for her. So as you can see on the screen, there she is, EYT of SoFi. Of course, that's Dan Nathan Swizzle here. Market call March 5th.
Yeah.
One thing we've been saying for a while now is, and we will get into this later in the show, volatility, which was manifesting itself in individual names, has made its way to the broader market. But I digress for a minute. Elizabeth, how are you?
I am fantastic.
You look fantastic.
Oh, thanks.
And you're in the home stretch.
Ugh.
This baby
I
will
feel like
be
I've been in the home
Virgo,
stretch.
huh?
I've been in the home stretch for like a month.
You're in the final countdown.
Well,
to quote a movie,
she's stretching.
Song.
There's no doubt about that.
There's a lot of stretching going on.
You know what's interesting? You ever hear that that thing where the baby Mozart thing, that the pregnant women, they play music for their kid and they come out, they're more intelligent. That your kid's gonna come out, he's gonna be like a little Warren Buffett. Think about that. She's been talking markets, she's been talking the economy, she's been talking stocks, that sort of thing. He's gonna be a smart little guy.
I'd happily give birth to the next Warren Buffett.
How about that?
Well, I mean, I visualize Warren Buffett now, and I'm like, that's sort of
100 years ago when he came out. Like, think about it. It was a
I knew Warren's mom.
A different experience then.
Guy went to the prom with Warren's mom. Hey, Guy just mentioned volatility, Liz, and I know in your note, is this your last weekly note for a while? You're going to.
It might be. Yeah.
Well, hopefully Mario will be sharing his note with us a bit. And Guy just mentioned stock market volatility, but man, the dollar, the volatility there, yield, the volatility there, commodities, the volatility there. And this is one of those things, and we can go back to, remember 15, 16, there was a lot of macro volatility, and every other risk asset was moving around other than stocks. And then the stocks finally caught up a little bit. When you think about, Liz, stock market and your, obviously your outlook, that sort of thing, normally you probably don't spend too much time thinking other than yield and dollar.
Yeah, I mean, look, there's nowhere to escape volatility right now. It is everywhere. It is pervasive. And yes, of course, yields have been volatile, but I feel like yields have been volatile for a long time. I mean, we've been talking about that on this show and saying these moves in treasury yields are not normal. And it's actually kind of scary that they're starting to feel normal on a daily basis. But when you have all of this volatility coming together in this sort of crescendo at the same time, where you've got not even just in the US, right? I mean, it's hard to find an asset class that doesn't have volatility right now in the US, but now go outside the US and even just look at what's happening today in Europe. I mean, we came in today and we have German bond yields down 20 basis points, right? Or up, 20 basis points. And that happened across a bunch of different European countries. So there's volatility all over the place. There's currency vol. There's even volatility in the gold market sometimes. So you can't get away from it. And I've got some charts that we can talk about later in the note, just to show really how high this is and compare it to not long history, but recent history, to see that it's not just stock market vol, where we're talking about multiples being high, we're talking about valuations being high and people repositioning. There's a ton of macro volatility. There's a ton of political volatility. It's everywhere.
I agree with you. And, we've been waiting for this, and finally we're getting it, for better or for worse. And we'll see how it plays out. And again, the swings yesterday, to lose, and put up an S&P chart real quick, but to lose 80 handles in the S&P in the last half hour of the day yesterday, which is basically what we saw, is unprecedented as far as now, I've seen days where they ramp them up into the close, but I haven't really seen a day like yesterday in a long time. Now, with that said, we finally got down to that moving average, and here we are. And we've talked about that being support, and we're bouncing off it for now, and we'll see if that continues. Obviously, this move is starting to accelerate now to the upside in the S&P. But as I said, with 3 hours left in the day, Dan, there's a long time to go.
Yeah, and I guess peak to trough, that was a 7% or so down to that kind of 57.30-ish level in the S&P. And, by all accounts, other than some of the intraday volatility that you just speak of, Guy, it's been fairly orderly. We've talked about how these volatility bands have widened a little bit, which kind of made us believe that there's probably more downside. Now we're going to be contending with that 57.30. And, we spend time talking about charts. Why are they important? Well, they are actually an important input to a lot of, models that are out there, they're basically trading the market. So Liz, why don't you just bring us to your note a little bit, because while we're here, we look at this and we say that's kind of the run of the mill sort of sell off as we've seen. I think there was a Doug Cass sent it to us, Charlie Bolello. He's pretty good on the Twitter. There's been like 35% peak to trough declines over the last, since the financial crisis or so. And if you just think about that, most of them, are probably maybe get down 10%. There's been very few that have down, more than 15% or so. So talk to us a little bit about what you were looking at, the work you were doing, and what that means for forward.
So leave this up for a second. And you mentioned that this has been orderly so far. I agree. It has been pretty orderly. Where it starts to get disorderly is if this support doesn't hold. Right? Things fall through support and you start to have this technical pattern where not only algorithms get triggered at that point, and then you got selling begets selling, but people kind of freak out because the rules, so to speak, aren't holding. So if we fell below this on the S&P, but also across a bunch of different indices and certain stocks and everything, then that's where things start to get disorderly. Fear takes over. And usually you've got another pretty quick 5% to go from there. And that's not necessarily scientific. It's just sort of market psychology. And keep in mind, despite all of this volatility, we're still only down 1% on the S&P for the year, right? Year to date. The NASDAQ is down 4.3-ish% or so. So obviously taking a little harder, but the Dow is actually still up on the year. So I think the theme that we're living through right now is that every day feels like it lasts so much longer, and we've got this news cycle that's not coming to an end. So if we just compare, if we look at the intraday moves in the S&P, this is the first chart in my note this week, the intraday ranges. So you've got this, a high to a low in the S&P. So the light blue line here is the daily range. And then we did a smoothed average because daily can be really choppy, like a terrible EKG. That darker line is a 5-day average. But just look at the level of these ranges of recent days, right? So we've got that light blue line. You have to go really all the way back to 2022 to see a time where we had consistently big ranges like this. And we all remember 2022, the S&P was down 19.4% in 2022. This is not predictive. I'm not saying that because we're having some of these big ranges, we're going to be down 19.4% this year, but we're having a similar experience so far as what happened in 2022. The other things that happened in 2022 were inflation peaked, right? In June of 2022, we were worried about what the Fed was going to do, what rate hikes were going to do to the economy. We had a lot of recession fears. So this is happening at a time where not necessarily driven by the same factors, but we're starting to have these growth scares, and it's baking into the equity market in the form of these big swings in volatility.
I agree with you. And again, the precursor to me, Dan, was the individual stocks. And now we're finally starting to see the follow through. And, even with the market rallying here, a VIX of 22 and change suggests you're going to have these big swings. And we've said this before. What the rally we saw yesterday, these counter trend rallies, and then the subsequent sell-off is textbook is, I think, what we're going to see. And I believe it, when we see today's rally off the lows, there's a lot of day left today. So to think that we're just going to continue this acceleration, I think there's a new paradigm here.
Yeah, and before we get to like expectations for the growth of the economy, that would be the GDP now is the one thing that people are kind of quoting a lot over the last few days, just because the volatility there. Let's just pull up, some of the sectors in which have seen a fallout from some of the trade war fears, tariff fears, that sort of thing. And, we have a chart of the day. We're going to get to that in a second. But Liz, some of these things have been really hard hit, right? And so the question you have to ask yourself is, are we likely to see some sort of resolution that is going to cause, let's say, autos or energy, to kind of get moving here? My picks as far as if we had a quick resolution would be, I think, a name like Taiwan Semi has been, and NVIDIA for that matter. I think some of the export bans and some of the increased tariffs are something that's been weighing on it. So when you think about the volatility downward in energy, I mean, is this a big component to S&P 500 earnings? Is this something that was meant to pick up the baton from some of these mega cap techs? And is that one reason why, if we're to get some of these growth scares behind us, you like energy here?
No. Simple answer, no. I don't think energy was expected to pick up the earnings strength that tech was going to leave behind. So actually the second strongest sector in the S&P for the year, earnings-wise, was expected to be healthcare. And then there's some others. Industrials is up there. Materials is up there. So I didn't expect energy to pick up the earnings strength necessarily. Plus, it's such a tiny part of the index. This is more about the idea that those first two groups there are actually related. So number one, autos has been the worst performing industry group since some of these tariffs were announced back on February 4th. So if you remember, the news came out February 4th that we were going to put 25% tariffs on Canada and Mexico, and then we delayed it a month because we were trying to wait for some sort of deal. Well, now here we are a month later. They went on. The auto index is down almost 30% in that time frame. So it's more about the discount that you'd get because of the trade war. So the things that have been hit hardest because of the trade war. Energy is actually right down there. I mean, not nearly down that much, but down about 7%. It's towards the bottom of the barrel when you're looking at industry groups and sectors. So I think you're getting a discount on this. And obviously cyclicality, if we're having growth fears, you've got cyclicality fears that are baking into autos and energy. So both of those, I think, would recover quite a bit. Plus, if you look at the map that Mario and I put out about a month ago about what our exposure is by groups and by products to Canada and Mexico, autos and energy are right at the top. So those are the two that I would still like. And that's not to say in Dan's picks, I mean, I think I've been pretty clear. I like China. Not just because of the trade war. That would, of course, be another tailwind if all of this calmed down, but I like China regardless.
I saw the chart of the day up because why not? Last night, we actually had a discussion about GM on Fast Money. And, one of the things that I thought we had just recently traded down to the lows we saw in October. And what I said last night was this was a logical place for it to stop. And, you got to trade around these things. And we went full basically circle from the October low to the recent high in December, back down to that October low. And, it was a bit of a place, again, to initiate a trade. Now, that was just blind luck. But if you're looking at GM today, we're seeing sort of that follow through. And it all makes sense. So I guess the point is, try to use this volatility to your advantage. I know that sounds glib. It's not meant to be. There are going to be days where things look scary as hell, and there are going to be days where things look as euphoric as hell. And in this environment, if you can sort of fade either side of those, you're going to be rewarded.
Well, and I think what 2017, 18, 19 taught us, when we started this trade war, I guess in 2018, is that, some of the fears, get kind of worked up before we know a lot of kind of how it's going to play out, what the, duration is going to be, that sort of thing. And, usually you're going to get an opportunity to kind of leg into something. I think, Guy, that's what you're kind of suggesting in a way. We're down nearly 23% from those highs. And what was that, late November or so? And I think it's important to remember that there was a lot of sectors like industrials, like cyclicals in general, that were trading very well after the election. We saw it out of energy, but a lot of these things kind of gave it up really quickly, right? And because I think they're saying, okay, the first playbook, Trump 1.0, might not play out the same way, So this is one where I think the autos are tough, to be honest with you. I think they're already stuck in the mud about a lot of different dynamics that post-pandemic sort of thing. And I don't think that, the trade war makes it particularly better. I also think structurally, the way these companies move so hard into EVs and then move so far out, I think they're going to find themselves possibly on the wrong side of this, unless hybrids, which both GM and Ford have really leaned into, is the way forward other than fully electric. But who knows in that regard, Liz, because a lot of this, and Guy has been talking about this, the kind of weakening of the economy, which has been under the surface. I think the movement in the Atlanta Fed GDPNow over the last few weeks has really caught a lot of people off guard. Will you quickly first explain how, like, and I don't mean like getting into the mechanics of it, but how did this GDP now, how did it become so important over, like, I think the last 5 years as kind of like an interquarter sentiment?
Yeah, well, we're impatient, honestly, and that's like the most simple answer I can give you, because GDP, the actual reading, never comes out until almost a month after the quarter is done. So it's such a backward-looking data point that it's not even worth reacting to at that moment. So this gives us a little bit more real-time read on how GDP is going. The hard part about it is that GDP is not something that shifts around on a daily basis. So I actually put this chart in here not to say, oh, here's why everything got so upset this week. I put it in here more to say, look how quickly it can change. It can come right back above that line just as quickly as it went below that line. So there are a number of inputs. This is a model for a reason. It is literally a model. There are a number of inputs that the Atlanta Fed uses to put these estimates out. There's really no scheduled update cycle either. So it's not as if we get this every Friday. It comes out, they change it, they update it when they want to because a new data point went into it. So what we saw happen this week, February 28th was last Friday, and it was showing a negative 1.5% estimate because of the trade war, because of the tariffs that were announced to go into effect the following Tuesday. So you can see in that negative 1.5 reading, the biggest drag on it is net exports, because we were expected to go into a trade war, which we did. So we came into this week thinking, oh gosh, the estimate is down quite a bit. And then on March 3rd, we got an ISM manufacturing number that was pretty bad. And the new orders were pretty bad. The employment number was pretty bad. And the prices paid were high. So that all culminated into a big input into this model and brought it from negative 1.5% down to negative 2.8%. This is an annualized number, quarter over quarter. But I think when people saw that, it was very jarring because all of the estimates up until this point were that quarterly GDP for 2025 would be somewhere between 2 and 3% positive. So this would be a huge swing. Now, if we get good data, and we did actually get pretty good data from the services index today, if we get good data going forward, again, these numbers could change quite a bit. If the trade war slows down, these numbers would change a lot. So don't freak out about these reads. And honestly, I really do think that the reason this became so popular is because we get it so much more often.
Yeah, and the Atlanta Fed typically is one of the more volatile places or feds or offices, whatever word you want to use that we've seen. I mean, things with them seemingly move on a week-to-week basis. With that said, this next slide I find fascinating, Elizabeth, because in the highest, when we are at our highest level of uncertainty politically or economically or whatever, that's typically when we see the best returns. And you can make an argument that we're right in the smack of it now.
Yeah. And this is, so shout out to Mario on this one. I actually had this entire section written without a chart, and he was like, wait, I have a chart idea. So, and then he came up with this. So this is, the section is titled Same, but Different, because there's been all of this wanting to compare right now to 2018 and the trade war that went on in 2018. You can't. Because 2018, the sole focus was on China. Those were new tariffs. Now we've got additional tariffs on China, but the focus today is on Canada and Mexico and possibly Europe in April. So this is a different reaction function. The market is reacting differently as well. So what we found was you've got this economic policy uncertainty index. We are right now in the 98th percentile of economic policy uncertainty for obvious reasons. But when you look at the forward returns, so 1 year after some of those high uncertainty readings, the forward returns are the best as long as uncertainty is at its highest. And usually that goes hand in hand. You have a market drawdown when uncertainty is high, and then you've got some sort of relief or resolution that occurs at some point in the next 12 months, and markets recover. Of course, there are exceptions to all of these rules, right? If for whatever reason this turned into an actual recession that lasted for a while, the chart probably would not be predictive of future returns just 1 year out. But this is something to keep in mind, and it's just to keep your head about you, right? That yes, things feel really dramatic for the last 30 days or so. That doesn't mean that they're going to stay this dramatic for the next 12 months. It doesn't mean that you want to sell and lock in all these losses and freak out and panic with everybody else, because what if it ends up calming down in just a few months' time?
Yeah. And, Liz, to help make this point, I guess, if you look at 2018, like you just said, a lot of folks want to compare it to that. The S&P had a sharp sell-off at the end of the year. It closed down 6.5% or so. But in 2019, when it got a lot of that loss back from the Q4, it ended up being up 29% on the year, right? So if you just think about that year over year, the one thing I'll just say, what's very different to me is that, the trade war, as you just mentioned, in 18 was really focused on China, right? Well, it's still focused on China. We've just added more tariffs, which it would take a very big deal between Trump and Xi to basically roll a lot of that back. But when you think about Mexico and Canada and the EU, and you think about the rhetoric, let's just start with Canada, the 51st state. Let's talk about Mexico, the Gulf of America. Let's talk about the EU and broadening it out from just a trading partner, which is one of the largest economic blocks in the world, next to us. It beats China, right? Doesn't it? I think so. When you think about
our biggest trading partners, Mexico, Canada, China's like third now, but
So then you think about just all of the geopolitical stuff that we've just seen with Ukraine, Russia, NATO, and then backing of Ukraine. I think that those sorts of inputs there change the dynamic dramatically. I don't think there's an easy fix with the EU. I don't think that there's I think that in many ways, a lot of these countries have been emboldened and the like. So, and the other thing is here, we just had this joint session of Congress last night. There is a large group of Republicans who are very quiet right now. They've been, you know what I mean? Like they don't have a word to say. These are all the fiscal conservatives. These are the ones who don't want tax cuts unless there's commensurate cuts, which is one of the reasons why Doge is being it's given the latitude that it has. But all the reporting on Doge is that they're not finding a whole heck of a lot. It's creating a lot of, uncertainty, in the jobs market, in the spending market, as you think about austerity. So I'm not saying the stock market is going to get hit really hard because of this, but I don't think it's going to snap back so quickly. And partially because the other chart that you just mentioned, the GDP chart, let's just say we see Q1, which is for all intents and purposes, not probably going to get too much better here if you think about it, because, even if you take the trade, tariffs off, it's not like companies are going to get back into gear and start spending again and rehiring or anything like that. So then all of a sudden, what's the definition of a recession? 2 consecutive negative quarters of growth. Well, we already got one in the can. And then I'd love to know, maybe Mario can come back to us next week. How often have we seen one negative quarter of growth that's not followed by a second one? That might be really interesting. Rant over.
Okay. So back to how this is different. I think it's very different for all of the reasons that you mentioned, because the tariffs are so broad reaching. We're not just focusing on one region. And there's been now threats of reciprocal tariffs, right? Whatever you tariff us, we'll tariff you back. And nobody's immune to that. And that would create a global trade war. So, and some would argue we're already in a global trade war because this is reaching a number of different regions. So I do think it's very different because of that. The second point I would make is that I think that there's probably a psychology among investors, and maybe even a psychology among certain people in Washington, that, well, if we just use this as a negotiation tactic and roll it all back and figure it out, everything will calm down and go back to normal, right? Or maybe back to what it was before. The longer it drags on, though, to your point, Dan, companies have to make choices. And as soon as those tariffs go on, they're paying higher prices. They're paying higher prices to get their inputs. They have to pass through higher prices. That stuff happens over just the course of a couple of weeks, a few months. They have to make changes and choices, and they even have to make cuts sometimes to maintain their margins. They can't just push a button and say, oh, okay, never mind, we'll change it all back now. So once some of those changes get put in place by companies, they're locked in for a while. And once the changes get put in place from consumer spending, that's also locked in for a while, because once you scare a consumer, they're not going to just start spending freely again after being spooked. So some of this, depending on the time frame, ends up being, I think, a lot more irreversible than what people are expecting.
A lot of this talk, obviously, bonds have a lot of play in this and how they're going to trade and what they mean. So if Amanda can put up a TLT chart, a couple of weeks ago, we showed you the downtrend line that the TLT had traded up to and then failed at. And that actually was working for about, 3 or 4 trading sessions, maybe a little bit longer than that. So we're going to show you this now. So there you go. So there's the downtrend that was in place. We traded up to it. We traded right up to it and failed. Then we had that little reversal, and now we're through it. So put that trend line up again, Amanda, because what I think is going to happen is we're going to do sort of this back and fill back down to the trend line. Now, the question is, Dan, what happens if and when we get there? Are we going to stop and bounce, or are we going to blow right through? Now, I'll play the game. I think we're going to blow right through that downtrend line, and then yields will go higher. But we right now traded up to the 200-day moving average, seemingly failed. What makes sense to me is that at some point we test that downtrend line, which means rates are going higher.
Yeah, and let's just pull up the 10-year U.S. Treasury yield. And so this is obviously meant to be the inverse, right? And so this is obviously the 20-year U.S. Treasury ETF, and that's the price. So here's the yield. And Carter Braxton Worth has made this point. This year over year, look where it is, same spot.
Yeah,
right?
no.
So what I'm saying is, and we've been talking about this for a while, my market has been like kind of 4 at 5, you know what I mean, in the 10-year yield. And I have a hard time, or maybe Liz, you can help me out a little bit. I mean, Guy has some very structural reasons why you think yields are going higher. I'm not smart enough to kind of get those, right? So let's pull up a 5-year here of that yield. I mean, we're really trading where we were back in 2022.
Mm-hmm.
You know what I mean? It's like, so I don't, like, to me, look at the stock market. It hasn't benefited from 4.8 down to 4.2, right? And it wasn't a huge impediment when it was up near 4.855. So that's why I think that market is really interesting. So Liz, I'm curious, you know, in your mind, what are the reasons why we would see a 10-year headed back towards 5%? Is it a re-inflation of inflation, you know, that sort of thing? What are some of the conditions that you think make sense that, you know, equity investors should pay attention to rising yields?
Yeah, so actually we tweeted about this today. If you can look at my Twitter, there's a basically prices paid component and its correlation with CPI. I think chief among some of those reasons would be if we do see a reignition in inflation, and there's a real risk of that. There's a lot of pressure building on that front right now. So we have to be careful about some of these inflation prints after the January effect rolls off, and maybe after some of these first quarter strange weather effects roll off. So inflation building would be part of it. I think what we're in right now, and who knows how long this will last, but the uncertainty that we're in right now is going to keep a lid on these yields because there's enough growth fear in the market to keep them down there. But to my point earlier, the longer this goes on, if it continues on and you've got growth fears that turn into growth reality fears, then you've got a 10-year that probably drops for a little while. And if you have recession fears that come in, Dan, to your point, so if we have a negative quarter in Q1, and what if Q2 starts to look unattractive as well, then you've got recession fears. Guess what goes up in a recession? Fiscal spending to save an economy. So all of this that has been trying to be accomplished by cutting spending would get reversed. And then you've got more spending from the government. You've probably got more treasury issuance from the government, and other countries demanding higher yields to buy our debt. So I think that would drive things up over a longer term period. Right now, I think things sort of stay where they are. Yes, this is the tweet I'm looking for. Let me just real quick do this tweet. So this is where the inflation pressure is building too. If you look at the prices paid, these are the indexes that we got this week. We've got services and manufacturing in here as an average. And you're seeing this force upward. That's both the magenta solid line and the magenta dotted line, the prices paid component moving upward. Over time, these track CPI pretty well, especially spikes in CPI. So if this continues, that blue line, which is CPI, is probably going to continue its turn upward as well.
Yeah, I mean, you're seeing it there. I mean, that basically, again, a picture's worth 1,000 words, and we've seen that sharp decline in the middle magenta line. Now it's turning. We've seen that before, by the way. It's not like it's unprecedented, and you see the subsequent move in the CPI. So it's problematic. And again, I'm not some dogmatic person when it comes to rates and stuff. You're just trying to read the tea leaves here. I understand that things are slowing down. I also understand that this is an administration that wants yields lower. But I also understand that I want a lot of things too. It doesn't mean you're going to get them. The forces at work here are a lot bigger. The bond market is a lot bigger structurally than I think people understand. And to Liz's, the later point she made, the market's going to demand a higher rate of interest to buy our debt. That's just factually true.
And you've been making that point. Another point you've been making is that, okay, the Fed can control the short end, but they can't control the long end, which has been made, very evident over the last couple of years, if you think so. Liz, help me, and I think Guy also, figure something out or actually put some context around this. And we might, I don't know if we talked about this on Monday on the Risk Reversal pod, but, we had Tom Lee on the pod last week. And he said something that I thought was really interesting, and I couldn't really figure it out. I actually emailed him, and so hopefully he's going to get me a response soon. So he said that if we do have, economic weakness, right? If we do have, let's say, consumers back off of buying large purchases, that it's actually deflationary. Right. And I was trying to get my arms around that guy a little bit. Yeah. Around the tariffs. Right. So if the trade war causes prices to go higher, you have consumers push back, right, or pull back and not make, we already heard Target saying and Best Buy, the prices are going to have to go up. Right. So do you buy that it's deflationary? Because the thought would be that it should be inflationary. That was one of the kind of headwinds to potential growth this year coming into, after the election.
Yeah, I mean, I think we did talk about it a little bit on Monday. So it's hard for me to see it as a good thing, first of all. The only way that I can try to twist myself into a pretzel to see that as a good thing is if it's that China continues to export deflation around the globe. We're putting the screws to China, and somehow we manage to not go into a recession, but all the other economies that we're putting the screws to do end up going into a recession, and somehow that becomes deflationary. The other way that it would become deflationary, at least in my view, that it would become deflationary in the US is that it's deflationary and recessionary. Because if you've got consumers pulling back because prices are too high, I mean, you have to look at the biggest component of GDP, which is consumption and private investment. If you've got both of those things pulling back, you're going to be in a recessionary or at least a spooky environment pretty quickly, which, yes, would then be deflationary, but I don't think that's the way that we want to get there. But there has been this notion, and I'm not saying that this is Tom's take. I would look forward to his email response to explain this to all of us. But there has been this notion over the last week or so that the Trump administration is trying to break inflation with tariffs. And I think some of that is where that idea is coming from. I personally don't think that that's necessarily how it works. I also think that the other things that would have to break in order to do that are not things that we're willing to withstand as an economy or that we want to withstand as an economy.
Yeah, and that leads to, I think, this administration, as Dan talked about this, and we've brought it up a couple of times. In Trump 1.0, the report card was the stock market. In this administration, seemingly they're more focused on yields because I think they feel that if rates come down, which is what they want, the stock market by definition will cooperate to the upside. So let's not focus on the stock market. Let's focus on something that we think if we get that under control, the stock market will act in kind. By the way, I don't adhere to that, but I think that's a school of thought.
Well, there's another school of thought that if you're trying to loosen up the housing market, right, because of, with yields coming down, if you think about, immigration and tariffs, those are massive headwinds, right? So the idea of, we've seen new home sales, we've seen some of this data really weaken. Well, a lot of the workers who are building new homes, have the risk of being deported, right? And then if you have input costs like lumber, which the Trump administration is also focused on, I just don't see an easy path to kind of this shaking out in the way that they'd like it to happen in the near term. And, I just want to pull something else up because I think this is interesting. We haven't even talked about tech, mega cap tech today. This is the first time I think we've done market call in a long time. And you know what? We're not going to talk about it. I want to go over to the equal weight. I want to go to the equal weight S&P for a second, the RSP, put in that 200-day moving average. And it's really interesting. This is a very different looking chart than the S&P 500. Now, it stopped at that support level in January. It's kind of gotten through there right now. But if this were to kind of break through to the downside, then I think you're going to see a catch up in some of those really large names that have been obviously a disproportionate amount of the performance of the S&P 500 over the last couple of years. Do you spend time, Liz, looking at the RSP? I know you do the Russell 2000. Guy covered it yesterday on Market Call. That thing looks like unholy death.
Yeah, so I do spend time on the RSP, and if I'm being honest, I own the RSP as well. It's a small allocation in my portfolio, but I do own it because I didn't want to be so market cap heavy. And the last time Jeffrey Gundlach was on about the Fed, he talked about wanting to be equal weighted instead of market cap weighted for some of the same reasons that we've all talked about, and because he thought yields were going to rise and pressure growth stocks. So if you are looking for market exposure and beta exposure, and you're not looking for market cap concentration, this is a better way to do it. So when you think about just basically the broadening out trade, of course, we all know what that has been. This is another way to express that in your views. One of the interesting things that happened today, and I don't want to take this macro again, but ADP payrolls came out today. And you can break that down into the size of businesses. Payrolls disappointed. They came in below expectations. Now we've got more jobs data on Friday that's more important. But my point about ADP is that the only size companies that did not add employees or did not add jobs were small companies. They actually deleted jobs. So I think they came in at negative 12,000, and then mid-size and large cap companies added jobs. So if small caps start to get hit here, not just because there's a cyclicality element, but because they're more sensitive to inflation, they don't have as many options when tariffs are put on of where to get their stuff from. And they don't have as many options on where to cut costs, and they have to pass it all through to consumers. And if consumers aren't going to absorb those prices, small businesses get hurt in that more so than large businesses. And they do make up a very big part of our economy.
Yeah, we might as well throw the IWM up real quick as well, because that's obviously, one would think with rates coming down, they'd be the benefactor of lower rates. It's not happening at all, because to Liz's earlier point, if rates are coming down because the economy's slowing, that's what it's manifesting itself here. So you don't have to believe me. You just have to look at this and start to connect the dots and say, wait a second, something's happening with small caps and yields are going lower. 1 + 1 equals a slowdown, Dan.
All right, let's connect some more dots. And our main man, John Butters, over there at FactSet. He is the senior earnings analyst. He writes the Earnings Insight blog. It drops every week. And there it is, factset.com/insight/subscribe. You can have it in your inbox every Friday morning, but we get a preview of it on Wednesday. So again, connecting the dots here, John is keeping a track of the mentions of tariffs. So let's go through this here. Terms tariff or tariffs, I like that, have been cited on the Q4 2024 earnings calls of 249 S&P 500 companies to date. Guy, that's nearly what percent?
Well, I mean, I can do that. I think it's half.
Yeah. Okay, there you go. This is the highest number going back at least 10 years. The previous record was 185 in Q2 of 2018. All right, let's stop here for a second, guy. So we just talked about the differences between 2018 and right now. Okay, does it really matter how many folks mention it then versus now? I just think the fact that we've seen an uptick in that almost suggests that it is a little different this time, and actually different means worse.
The only thing I would say to that is, I think 7 years later, a lot of the people that talk on these calls are a bit more savvy in terms of, what can I put in to, I don't know, not muddy the waters, but to sort of give me some air cover.
Yeah.
And, I think they've learned how to play sort of the social media game. So 249 today might be exactly the same as 185 7 years ago. But with that said, I think it's important to point these things out. I mean, you remember what was happening 7 years ago in the second quarter.
Yeah, Liz, let's talk about the sector front here. The materials, 82%, and industrial, 77% sectors have the highest percentage of the S&P 500 companies citing tariffs on earnings calls. The communication services, 5% sector, has the lowest percent of the S&P 500 companies citing tariffs on earnings calls. So that makes sense. Walk us through your thought process there.
Yeah, I mean, the announcements that came over which countries were going to be tariffed and what the inputs would be, a lot of this does target manufacturing and it targets consumer goods. So this does make sense. We're looking at materials, industrials. There's been a lot of headlines about steel. I think that's bleeding into that. Industrials are those big, conglomerate companies that need all of the inputs to make the stuff in order to make their big machinery. So I think that makes sense too. You've got airlines that fall into some of this, and then consumer discretionary is where autos fall. So now, number one, you have to think about this from a CEO or CFO standpoint. They're trying to explain why they're being cautious, right? They're trying to explain why they are changing their guidance perhaps, or why they are coming out with earnings that meet or beat, but then saying for the rest of the year, we're not sure, we're kind of putting things on hold. And that's the first step to what I talked about before, where putting things on hold, pulling back a little bit just to wait and see what happens is the first step that you take before you have to actually change things, because tariffs have actually gone into effect and stayed in effect for a while. So I don't see this, to the point earlier, as that much different from 2018 yet, the fact that they're mentioning tariffs more. But if this lasts longer, then I think we're going to start to see it in the results, and we're going to start to see it in not just guidance, we're going to see it in what happened in the actual quarters.
All right, Liz, we're going to get a final word from you. Guy, we may not hear from her for a few months here. I mean,
well, I hope we hear from
we're hoping
her.
to get her
You'll hear
back
from me.
in like a 2-month maternity leave. That would be absolutely amazing.
Take as much time as she
that would be
wants.
amazing for us.
We will
Okay,
be here
Just wanna
when
be
she
really
gets
cool.
back.
All right, so I need some sort of kind of guess of where you think you're going to get back in the summer, right? Where do you
Yes.
think the S&P is going to be? Because our main man Doug
Ooh.
Cass sent over a note here. Okay, he says he estimates the downside market risk is roughly 2 to 3x upside market reward, which I think is an interesting way. Now, I know that he's basing that a little bit on valuation, a little bit that S&P earnings estimates are a little too high. You throw in all the uncertainty around trade and tariffs and weakening economy. He probably thinks you come into mid to high single digits earnings growth at best. So what is your take here? Without getting too granular, do you think the market's up, down, indifferent by the time you get back?
I think it's probably up, but not much. So I will likely get back in the heat of second quarter earnings season. And it'll be sometime, let's say late July-ish. So I'm going to guess that the market is up mid-single digits by that point, but it could be ugly before then.
I will say that there's I don't want to say a 50% chance, but there's a very good chance, the way that traders look at it, that we go back and look at the levels we saw in September, which is about 5,400, and with an outside shot of seeing that August 5th low yet again. So, and by the way, that could happen, and Elizabeth still could be right, given the volatility we could see.
I think we're going to see a lot of strategists, a lot of economists start using that term back half loaded, right? It will say that this uncertainty is going to kind of, weigh on valuations. It's going to weigh on sentiment. There's going to be continued a lot of uncertainty. The geopolitical stuff certainly doesn't help. And so you better hope that things pick up in the second half of the year where we have more certainty. But I think you made a great point, Liz, before. I mean, the S&P is down 1.5%. So we're talking about a 6.5% peak to drop decline. It did feel orderly to me over the last week and a half, other than these intraday moves. And if you took the volatility out in commodities, in rates, and in currencies, you know what I mean? I'd say, this is kind of it's good. We took a little froth out of it, because the other point that guy started the show out by saying is like, there was a lot of single stock volatility under the hood, which should have made you think that some of these meme stocks that got to 100 billion, 200 billion, 300 billion in the case of Palantir was anything but healthy for the stock market, guy.
The old saying, if the queen had balls, she'd be the king. The king laughed. He had to.
Nice.
So we can, you can, if
Liz, by the way, couldn't you just say that every saying that guy says is an old saying? Like, wouldn't that be fair to say,
I think
right?
that's fair.
So I just want to be, all right, give us a final word before we take this thing home here.
A final word. Well, when I come back, I will be a mother. I will be a different person, a different professional. And I am interested to see how much I miss it. I think being away from the markets is going to be hard for me, but I'm very much looking forward to this next phase.
I'll say this with certainty. We will miss you. So God bless you. We mean that sincerely. As we've said 100 times, this is a very lucky child to come into the world with you as his mom. I can say his because we know it's going to be a boy. So
that's right.
Big kiss, Elizabeth Young Thomas.
We're going to miss you. Thanks, Liz.
Thank you. Bye, everybody.
Bye, everyone.